Real estate investment trusts are today offering historically high dividend yields. This is because over the past 2 years, their share prices have crashed even as most kept hiking their dividends. As a result, there are many REITs that today offer up to 8% dividend yields that are safe and growing. Hey everyone, I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about my two favorite 8% yielding REITs. Both of these REITs are today heavily discounted and offer safe and growing 8% dividend yield that was recently hiked. But before I get into it, I wanted to let you know that I plan to soon post a few interviews with different REIT CEOs on this YouTube channel, so make sure to subscribe if you don't want to miss it. And secondly, if you want to help me grow this channel, I would really appreciate it if you could click the like button. Thank you so much in advance. So the first REIT I want to discuss here is called Armada Hoffler. Its ticker symbol is AHH. It's today yielding over 8% and it just recently hiked its dividend by 5%. Armada Hoffler is what we call a diversified REIT because it doesn't specialize in one specific property sector. Instead, it's today investing in retail, residential, and office buildings. Generally speaking, I don't like diversified REITs because you cannot expect to beat the market by being a jack of all trades, but I think that Armada is an exception because of 3 reasons. The first reason is that it is geographically concentrated. They've been investing in the Mid-Atlantic and the Southeast for over 40 years, and so they're absolute experts in these specific markets, and this allows them to play in different property sectors. Most other REITs will instead focus on one specific property sector, but they will then invest across the entire nation, and so they won't be experts in every single region either. Armada simply does the opposite, and so what it's lacking in sector concentration, it's making up by being an expert in its local markets. The second reason is that Armada is following a private equity approach. It's in many ways more similar to an opportunistic private equity real estate investor than a traditional REIT. What I mean by this is that it's very active in its investment approach. It will typically buy land, build the properties themselves, it will flip some of them for profit, it will retain some others for its own portfolio, but the point is that it's very active. It's not just buying stabilized properties that it holds to earn rental income. In fact, Armada is so active that they even have their own construction business and they're offering services to other investors, earning additional profits, and this gives them a competitive advantage as they develop new properties since they're able to build at a lower cost. And then the third reason why I think that Armada is an exception among the diversified REITs is that it owns a lot of mixed-use properties. And so in a way, it's actually wrong to classify Armada as a diversified REIT. We should really create a new property sector for Armada and call it a mixed-use REIT, because it will often buy big tracts of land and it will build all the different uses, some retail, some office, some residential, all within a walking distance, and that's what we call mixed-use communities. Such properties are highly desirable, they enjoy high barriers to entry, and they will typically also command large rent premiums relative to other comparable properties. And so these 3 reasons explain why Armada Hoffler has been one of the few diversified REITs that has managed to outperform the average of the REIT sector since going public. I'll put a chart here on the screen where you'll see that it has massively outperformed the Vanguard Real Estate ETF as an example, and you'll see that I stopped that chart with the pandemic because ever since then it has actually been a significant underperformer, likely because it's a small cap REIT, it's using a bit more leverage than average, and it earns about a third of its NOI from office buildings. As a result of this crash, it's today priced at its lowest valuation in many years, trading at just around 8 times its FFO, an estimated 35 to 40% discount to its net asset value, and an 8% dividend yield despite just recently hiking it by 5%. The interesting thing here is that despite this low valuation, the REIT is actually doing really well. As I just mentioned, they are still growing their dividend, they are earning record levels of FFO per share, which is the equivalent of cash flow in the REIT sector, and the company just held their conference call and the management seemed to be very bullish. Here's what the CEO said on the call. We've raised the dividend a solid 5% this quarter. This increase brings the dividend into alignment with our long-standing coverage parameters of approximately 80% of AFFO. More importantly, it is indicative of management's confidence in the trajectory of our business model, increased property NOI, strong leasing activity, and development income expected to come online in the 4th quarter. All factor into our confidence in our core business and the sustainability of our cash flow. And so essentially what they are telling you here is that they think that they will enjoy strong prospects for future growth and therefore they are able to hike their dividend. This is not exactly what you typically hear from REITs that are priced at such low valuations and high yields. Typically those are doing quite a bit worse than this. And so what is the market missing here? The first thing is that the REIT has high exposure to service-oriented strip centers and multifamily. It's today generating about 70% of its revenue from these two property sectors, and they're both doing really well. You probably know already that apartment communities are quite desirable investments that typically trade at very low cap rates even in today's higher interest rate environment, but what you may not know is that retail properties like service-oriented strip centers are even more desirable today. That's because retail has been out of favor now for a long time, and as a result there's been very little new supply hitting the market. This puts these retail properties in a strong position to keep growing their rents, particularly in Armada's Sunbelt markets, which are enjoying strong population growth. The second thing that the market appears to be missing here is that Armada owns some office buildings. That is true, but these are trophy Class A properties, mostly in mixed-use destinations. And so it is true that offices are today struggling, but this is not your typical commodity office space. These are true trophy properties. Remember, I said earlier that Armada is a real estate developer. Most of its properties it has built itself, and some of its properties it will sell to other investors, some it will keep for its own portfolio, and so you can imagine which properties it will keep for itself. It's typically the trophy assets, the creme de la creme. This is well evidenced in the average occupancy rate of its office buildings, which is today over 96%. This is far higher than the average of the office sector. Here's what the management team said about their office buildings on their most recent conference call. As you know, our office products are best positioned in their respective submarkets and are integral to robust and active mixed-use ecosystems. These factors have resulted in our Armada Hoffler's portfolio benefiting from the continued flight to quality evidenced by elevated occupancy and leasing activity, as well as establishing their own superior market rents that defy trends in the office space overall. Then they added that they expect to maintain relative outperformance of their competitive sets to not only continue but even accelerate over time as employers prefer highly amenitized Class A assets in mixed-use environments. And so what's happening today in the office sector is that the lower quality buildings are suffering, but in a weird way the higher quality buildings actually may benefit from this as employers reconfigure their office footprint, and often they'll reduce the total amount of space that they lease, but they will prefer to be in the higher quality buildings such as those of Armada Hoffler. And then the third thing that the market appears to be missing, or at least underestimating, is that the management is very well aligned with shareholders here. It seems to me that one of the reasons why the stock of Armada dipped recently is that the management indicated that they may use their ATM in 2024 to issue some shares and raise some equity. This appears to have scared some investors, and understandably so, because the share price today very heavily discounted, so if they raise some equity it will lead to shareholder dilution. But I really don't think that this is something to worry about here. I met the management in person last year at a conference. I know that they own a lot of equity themselves, and they have shown a strong history of shareholder alignment by making very conservative use of their ATM. They would only raise capital when they could invest it accretively in the way that grows their earnings on a per share basis. And so I think that the commentary concerning the ATM was really meant that they will use it opportunistically. If their share price recovers, they may issue a little bit of equity to help them with the new development projects. But I sure don't expect them to raise a lot of equity at today's prices. I think that that's very unlikely and that the fears here are overblown. And so with all that said, I think that Armada today is very heavily discounted and quite opportunistic. Typically, strip center REIT or apartment REITs today trade at closer to 14 to 16 times FFO, yet Armada today's price at just 8 times FFO. If we just recover it to 12 times, that would unlock about 50% upside from here, and while you wait, you're earning an 8% dividend yield that's well covered and growing. What appears to have happened here is that Armada has been beaten down simply because it has some exposure to the office sector, and the market has not recognized that these are trophy Class A mixed-use properties. And then secondly, this is a diversified REIT, which typically trade at a discount relative to specialized REITs. But again, here I don't think that this is really warranted because they're so heavily concentrated in a few geographic regions, and Armada has a unique approach of being very active following this private equity approach, having their own construction arm, which gives them competitive advantages. Before I go into the second REIT, I want to remind you that you can access my entire real money REIT portfolio by joining High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. This is a real 2-week free trial. You won't be charged anything in the first 14 days. So if you want to come just to access my portfolio and leave, that's perfectly fine with me. The second REIT I want to discuss here is called EPR Properties, ticker symbol EPR. I've mentioned it quite a few times on this channel. This is a net lease REIT that invests in experiential properties like movie theaters, golf complexes, hot springs, and so on. I just recently highlighted EPR on this channel, so if you're not familiar with the company, I'll put a link in the description of this video so you can get an overview of it. Instead of repeating all these same facts, I'm today going to focus on its latest fourth quarter results. Just like Armada, EPR is today priced at a very low valuation at just around 8 times FFO, and it's offering an 8.3% dividend yield, and despite that, its latest results were very strong. Here are some of the highlights. They managed to grow their FFO per share by 6% in 2023, reaching a new record high that's on par with pre-pandemic levels. They guided for another 3 to 4% of FFO per share growth in 2024. They hiked their dividend by 3.6%. They also guided to acquire another 250 million worth of properties at high cap rates. Lately, they've been getting cap rates even above 8%, so these are very accretive on a per share basis to their results. Their rent coverage ratio of their non-theater properties now has reached 2.6 times, which is far above their pre-pandemic levels of about 2.2 times, and even their movie theaters have now seen their rent coverage ratio recover to pre-pandemic levels. This is very encouraging in my opinion because it really shows you that the fears over the movie theaters have been overblown. Its tenants are able to operate them profitably already today, despite a box office that's still 20% below pre-pandemic levels. And since EPR is just a triple net lease landlord that has lease terms of over 10 years with automatic rent hikes, I think that the cash flow is going to be highly consistent and predictable for years to come. But despite that, EPR is today still heavily discounted as if it was going through a severe crisis, but that's really not the case anymore. It is true that it suffered temporarily during the pandemic, and understandably so, because experiential properties couldn't really operate their businesses anymore under the severe COVID restrictions, but those times are now over, and the vast majority of EPR's properties are doing far better than before the pandemic. As I mentioned before, the rent coverage ratios of its non-theater properties, which represents about 75% of the portfolio as measured by its NAV, is today a lot higher than before the pandemic, and even the weakest link of its portfolio, which are the theaters representing about a fourth of its NAV, are today performing on par with pre-pandemic levels. So once again, what this really shows you is that the crisis is over, EPR is back to business as usual, and yet it's priced as if it was still undergoing a crisis. 8 times FFO or 30% discount to NAV and a 8.3% dividend yield is very unusual valuation for an investment grade rated REIT that has a long history of significant market outperformance, and I don't think that this will last for much longer. I think that in the coming years, as EPR keeps diversifying its portfolio away from movie theaters and as box office continues its recovery, the market will eventually warm up to EPR and the fears will dissipate, resulting in an FFO multiple expansion if it repriced to just 12 times FFO, which would be still a discount relative to other net lease REITs like Realty Income, NNN REIT, Essential Properties Realty Trust, and so on. It will still unlock about 50% upside, and while you wait, you earn 8.3% dividend yield that's paid monthly and growing. So these were two examples of 8% yielding REITs that I'm buying today. I think that they offer very good risk to reward for investors, but there are many more such opportunities today in the REIT market. And if you want to access my entire real money REIT portfolio, you can join High Yield Landlord for a 2-week free trial. I'll put a link in the description of this video. Thank you so much again for your support. If you have any questions, let me know in the comment section of the video. If you could please click the like button, that really help me a lot. And finally, subscribe to the channel if you don't want to miss any of my REIT CEO interviews. See you at my next one. Bye bye.